You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome back to the Infinite Banking Mastery Podcast. I hope you are well and had a great week. Today's topic, what are the downsides of infinite banking? I mean, really, are there any? I really don't feel that there are any downsides, but when I get asked this type of question, such as what are the downsides of infinite banking? What are the cons? What's negative about it? There's always one thing that pops into my mind. Although if you stick with the policy like you're supposed to long term, then I really don't see it as a downside, actually. But the one thing a whole life policy built for use with the infinite banking concept is a short-term vehicle. Infinite banking is not suitable for those seeking short-term financial solutions. It is definitely a long-term vehicle and requires a long-term commitment to realize its full potential. The longer you have the policy in force, the better it becomes. The more seasoned it becomes, the larger your snowball of cash becomes due to the uninterrupted compounding interest for years and years. Each year that passes projects better and higher cash flow once your policy has become cash flowing, that is. If you surrender your policy within the first few years, you would not recover all of your cost basis, all the money you've paid into the contract. Whole life policies are so great, but one thing they are not, again, are short-term vehicles. This is truly the only downside that I see that people would consider a downside, that someone that is looking for something short-term, they really want to get their money to grow fast and then pull it back out. So that would be a downside for someone who was looking for something like that. But how I see it as what it takes to get my cash flowing asset up and running. Another thing that those that are newly learning may consider a downside is that during the initial years of the policy, you do not have access dollar for dollar to every premium you've paid in. This means that the liquidity of your funds is a bit restricted, and you may not be able to withdraw as much money as you would like or intended to in those early years. In the first year, you do not have access to the portion of the premium that's called the base premium. The base premium is what is supporting the death benefit, the initial death benefit. Nelson Nash always referred to those first few years as the startup costs to your system, because just like any business or real estate you purchase, there is a cost before that business or real estate will become cash flowing. If you're starting a business, you will have to purchase or rent a location, furnish your new building, possibly buy inventory, hire employees. There are a lot of costs to starting a new business. If you desire to purchase a rental property for that future cash flow, there is a cost to that, the down payment and cost to prep your rental to be rented. I've shared the story before of my first business, a coffee stand, and how it cost me about $40,000 in startup costs to start it. But I was okay with that because I was excited, I was hopeful and determined to create a cash flowing business. And that's what it took to begin. When I'm discussing this concept with people, if they haven't read the book or done enough study on the concept, they will wonder why they don't have access to all their money in the first year. So I go back to my coffee stand example. After I spent that $40,000 to open the business, the next day I did not have access to $25,000 of those dollars. I had access to none of the dollars. I had just spent, all I had was a building, some machines, some coffee, milk, and a whole lot of prayers that people would come buy coffee. So when you begin your own banking system using a whole life policy and you actually have access to a large portion of cash immediately after paying your premium, I would say that's pretty good as compared to starting a retail type of business. Because of the startup cost to your system, those first years, your cash value will be at a deficit against the dollars you've funded into the policy. But then your policy will become cash flowing and the growth will only improve over time. Every so often, I'll talk to someone who is surprised they don't have access to all of their premium dollars right away, or they think they will have access to borrow against the death benefit, which is always much higher than the cash you have inside the policy. Well, you definitely don't have access to borrow against the death benefit, only your cash value. And although we use the analogy that those costs in the beginning are similar to having startup costs for any business, you have to remember that this is a life insurance policy. And so, of course, there is a cost to the death benefit that you are securing. The fact that you don't have access to every bit of premium you fund into the contract year one and those beginning years should make sense due to the cost of buying a death benefit. This is still life insurance. It's these startup costs that are the reason for the policy not being a short-term vehicle, because it will take a few years before the growth of your cash value will grow enough to basically erase those startup costs. For a lot of people, the concept of infinite banking can be complex and difficult to understand. Although fully learning the concept can feel overwhelming at times, what's actually happening is very, very simple. All you're doing is funding a whole life insurance policy built in such a way that fuels your cash value to grow more quickly in the beginning years while protecting it from becoming a MEC, a modified endowment contract. And you are able to borrow against this account value all your life while protecting your family with a guaranteed death benefit and while your cash continues to grow on a guaranteed basis. Because you are able to borrow against your collateral, which is your cash value account, while not touching your actual cash value. So your account is still able to grow. And if you do so correctly, you will be able to access the earnings in your account, income tax free, all of your life. It's the why would I want to do this that takes all the learning. That's why most all of us practitioners want you to read Becoming Your Own Banker First by Nelson Nash so that you have a baseline of understanding for us to teach from. Having a practitioner as your coach will help ensure that you have the proper policy structure and ongoing guidance so that you will have the most success possible with your banking system. Just about every single time I've taught someone from cold, like they didn't know any information, no studying, no reading, just about every single time they have told me this is too good to be true. It's just too much information and it can become very overwhelming. And that's why we like for there to be a baseline of understanding before we teach. People who are learning might think there are initial high costs or that they need to be able to fund with a large monthly or annual premium. But really, the amount of the premium is almost 100% up to you. There are minimum amounts you must start with if you want a super duper low premium. However, I almost never come across any kind of required minimum premium for anybody because even the amount that they want to start with is high enough to meet that minimum death benefit. Now, if you're just comparing pure premium of a whole life policy next to a term policy, the cost of the death benefit will be higher on a whole life policy. And of course, that's because with a whole life policy, the company is guaranteeing to pay a death claim on your life until you reach age 121, as opposed to term, which is only for maybe 10 years, 20 years, 30 years. And so they're not expecting to have to pay that death claim. And so, of course, the one where they are guaranteed to pay a death claim would have a higher cost. The internal costs of the policy are not listed out like they are for universal life policies, and I sometimes get asked, why can't I see the fees? Though even though you can't see the fees in isolation of everything else, your comfort really should lie in the guarantees of the policy. Once your contract has broken even and begins to grow and grow, what then is your cost to the policy? If you paid into the policy $100,000, for example, and your cash value is $200,000, and you have access to that $200,000, what was your fee? And does it really matter what your fee was? In addition to having access to double the amount you funded into the contract, that $100,000 you sent to the company in premium is also providing a death benefit of, let's just say, $400,000. And both the death benefit and cash value are guaranteed to be there, and the cash value is guaranteed to increase as you age, all the way to age 121. But remember that this isn't the vehicle to be seeking high rate of returns that outpace the S&P 500 or something like that. This is the place where housing your savings dollars are going to do much more for you than they would in a savings account. And if you treat yourself like an honest banker and continue to grow your system over time, this process of banking can absolutely blow whatever else you're doing out of the water. Maybe that's why bankers are doing so well. So you might not be able to see the exact cost of the fees or mortality charges each and every year, but you do have the peace of mind that the policy's cash value is guaranteed to grow. That guaranteed growth will look more impressive the younger you are, of course, but that doesn't mean a whole life policy won't meet someone's needs who's in their 60s or 70s. The great thing about funding a whole life policy first, before looking into investments that you're interested in, is that you can run your money through your banking system first and keep from missing out on the opportunity cost of those dollars, because they can do double duty. You can run them through your policy and still move forward with whatever other investment you are interested in. Of course, remember, if it's year one, you won't have access dollar for dollar to all the premiums paid in. But in general, you don't have to choose between doing this or doing that. You can do this and that. Life insurance is an and asset. Another common concern, a concern that you might have, is about starting a policy and having to maintain the premiums over the long term, over your whole life. Because whole life, usually the premiums do go for your whole life. But with a whole life, you actually also have the option to stop your premiums sometime after year 7, if you really needed to. When I speak to clients who are really, really interested in only paying the premium for a short period of time, say 10 years, I always advise to continue funding through at least year 10. Although usually it's fine if you need to stop, if you really need to stop sometime after year 7. Someone selling you a universal life contract will also tell you that you can stop funding into that policy as well. However, there's definitely the danger of increasing costs inside of that type of contract over time. And so if you're not paying any premium and there's increasing costs, kind of a double whammy, it can start really taking away from the cash value inside of your contract. When I do come across those who really want to stop the premium in 10 years, or they just think they won't be able to fund anymore after that, I always suggest that they keep an open mind about continuing to fund and have the contract built in such a way that if they wanted to continue to fund, year 10 rolls around and they're like, hey, I can still fund, that they would be able to make that choice at that future time. 10 years from now, you may realize that you still have enough cash flow coming in and you need a safe place to store those dollars. Your contract will continue to grow very efficiently if you stop premium after year 10. It simply won't have as much cash inside as if you would have continued funding it, simply because you stopped putting dollars in. So again, the only time I would tell someone that a whole life policy is not for them right off the bat is if they were to tell me they're looking for large growth in a short period of time and they plan to remove their cash. Or that they plan to discontinue their policy within a few years and cash out. Just grow as much as possible in 5 to 7 years and cash out. Whole life is definitely meant for the long term. Well, thank you for listening. I hope you got something out of today's podcast. If you are looking to begin and would like to partner with me as your agent, your advisor, your IBC coach, please reach out to me. You can reach me at Valerie@alphaomegawealth.com. Have a great week, everyone.
This is thepodcastfactory.com.